So now we have our variables for our option, both within the contract, as well as a few variables that we're going to have to get outside the contract. We can start thinking about how we might come up with the fair value of this. Now, if you recall from our discussion about doing fair value, there's two fair value models that we can utilize. So, and again, when we think about fair value, we think about the accounting for this. We can go back to the codification. Let's do that. Let's go back to the codification. And under broad transactions, we're looking for fair value measurement 820. Right? And we can go through and make sure we have an understanding about what are the different areas or how do we come up with fair value. So we always go to 820-10, again looking at recognition, initial measurement, subsequent measurement, etc. But here we want to think about option, right? And the three methods that we talked about for fair valuing anything was a market approach, an income approach, and a cost approach. Now, for financial instruments like derivatives, we don't use a cost approach. So it's either going to be a market approach or an income approach. And as you recall, there's different levels. 1, 2, and 3. Level 1 is always going to be a market approach. Always going to be a market approach. What level 1 is identical assets trading in an active market. Okay, that is a level 1 fair value. So if we think about our Apple option, we could look up that price. We can look up the price of that December 2020 option, whether it was the call at 500 or 300 or what have you. We can actually look up that particular option in the marketplace and get a reasonable price. Whether we use the bid, the ask, or the last depends on how big of a spread we have between the bid and the ask. But we can always go back and use, for exchange traded options like that, we're always going to use a market approach. Now, we can still use a market approach for level 2 and for level 3. But here, when we're using a market approach, what we're looking at is similar assets or similar instruments. Okay, so this is all market approach. Level 2 and 3. This is similar assets that have a fair value. The level 2s have observable inputs. To market participants. Level 3s are unobservable inputs. Okay, but you can have market approach looking at similar assets, right? Level 2, we can go to an actual marketplace where similar assets are traded in an observable market versus level 3, there are similar assets, but they are unobservable. And what this level 1, level 2, level 3 does is it really describes in the disclosures that these might be lower risk as far as the variability around the fair value, a little bit higher risk, and much higher risk as we move from level 1 to level 3. And investors and users of financial statements want to know where are the risk profiles in your fair values. Now, if you don't have a market or similar assets for your particular option, you can use the income approach. Right? The income approach is always going to be level 2 or 3. And unsurprisingly, in an income approach, it's the inputs into your income model that are either observable for level 2 or unobservable for level 3. And when we think about an option model, we think about an income option model, we think about the Black-Scholes model. And when we get to stock-based compensation, we're going to show and do a demonstration on how to utilize a Black-Scholes model. But in this video, I just want to show you what it's trying to capture. We're not actually going to go through the math, but we're just going to at least show you what a Black-Scholes model is attempting to capture. So let's stay with our call option. And we'll stay with the call. Okay. And let's set up our variables. All right? So we know I have a buyer and seller. We know what the asset is, right? And we have an idea of the quantity, all right? And more importantly, we now have an exercise price. So let's assume for a moment, and this is start date, and this is expiration date. Okay, start date, expiration date. Start date, expiration date. Okay? Let's assume for a moment that our exercise price is right here. Okay? That's our exercise price. So at any time between our start date of the option and our ending date of the option, we can purchase, for the call, we can purchase this particular stock. So this is going to be exercise for the call. Okay? Now, the market price is here. So the first question you got to ask yourself is this for a call option? Is this in the money, at the money, or out of the money? Well, I have the right to buy it at a higher price than what the current market is. So the question is, would you exercise this option? And the answer is no, because I can buy it at a lower price right now without exercising the option. So this is an out of the money option. If the market price was here, right on the exercise price, that is at the money. And if the exercise price was up here, up top, that would be in the money. So this is a out of the money option at the start date. Now the expectation is that this price, the reason why I bought it is because I believe that it is going to be higher at some point in time over this period, over between here and here. Now, if I believe that the price is going to go up and the price looks just like this, then over time this option will have some value, and at the date that I write it I should be, if I'm the person selling it, I should figure out what is the fair value given our expectation of this. I should be able to price it at that price. If we both believe that that's what's going to happen. Now, is this how market prices actually behave? Nice thin line. The answer is no. Market prices tend to do these kinds of things. Okay. So when would somebody exercise this particular call option? They would exercise it at points where they believe that here and here, in any of these areas where it is over the exercise, is likely points when they would exercise. So when we think about trying to figure out what the value is, it's not just about the market price, exercise price, this distance. It's also about the movement of the stock price or the expected movement of the stock price. This is referred to as volatility, and we can calculate implied volatility. We use historical data that happened way back here, and we try to predict what's going to happen out here. If the market price did this, and I'm trying to draw basically a straight line, there's no variability from day to day. There's no trading variability. The volatility of this line is equal to 0. And so therefore, when you have volatility equal to 0, the value of this option would be 0. The more volatility you have, the higher the fair value of the option. Now, I mentioned American versus European. With the European option, I can only exercise on one day the expiration date. So if we think about a European option, that has less value because I can only exercise right here. And if that's the case, I may not exercise because it looks like the exercise price and the market price are the same. So I don't know why I would exercise. Maybe there's a little bit of a difference there, but not much. An American option I can exercise every day. Every day I have the opportunity to exercise. And then there's other different kinds of options that exist. A Bermudian option, maybe you can exercise it 4 times a year. Others, maybe there's set dates when you can exercise. But the American option gives you more flexibility when you exercise versus the European option. So you can see that the American option, the way if it's written as an American option, will have more value to the buyer than a European option. And that should be built into the pricing of when I'm trying to figure out the fair value. Now, if this was the put option, we're going to use basically the same kind of valuation model, but if this is a put option and the market price is here and the exercise price is here, right now, this option, the way it is, it looks, is in the money. If the market price were up here, it would be out of the money. And of course, if it's at the exercise price, it's at the money.